Now, you mentioned something as one of those indicators to keep an eye on was inflation. Let's talk about that. What about the inflation? You said it's slowing in September, but what about going forward? Do you see that, the signs are lining up, those other economic indicators are lining up to say, hey, you know what, if that's a driving force, is inflation in check and going in the right direction to encourage Fed and, quite frankly, the bond market to say, hey, it's time to lower some more rates?
Well, yeah, I think so. I mean, again, the key thing I think will be the next, jobs numbers report, because I think the September jobs number report was a little bit sort of on the fringe in a sense that it was a much bigger number than expected, and so assuming that when the next release comes, if it's more subdued, I think that's going to help things. Again, remember that the Fed's inflation target is 2%. Well, if the CPI year over year currently is at 2.4, well, gee whiz, we're not that far off from their target, right? Again, it was a year and a half ago, it got up to 9%. So the Fed, to give them some credit, has done very well in getting us back to the target goal of 2%. But, getting that last 0.4, 0.3 out of the numbers, so we're back to 2%. It's going to be important that the labor numbers get more subdued, and I think they are. In fact, there's some observers, Wells Fargo Bank, for example. I read an article. They were bullish about today's number. They were expecting it to come in as forecast at 2.3. They were off slightly, but they are of the belief that there's going to be future job numbers in the rest of this year that are going to show some more softening. And I think if that proves to be true, then we're going to see the inflation numbers also keep going in the same direction. But this is going to be a very gradual thing. I think to get to 2%, we may end up looking at maybe not getting there by the end of the year, but maybe first quarter of 2025 or even beyond that a little bit. So I think it's going to be a case of chipping away at a very slow pace. But as long as that pace is in the right direction, I think we're going to eventually get there.
Well, you mentioned about the employment numbers, and I was watching something today where they think that the unemployment numbers and the claims will be a little higher, but they said they've already baked this in because it's really weather related, because we're talking about those states were hit by Hurricane Helene last week, and now Florida, and there's going to be some bump in those claims, and so they kind of already baked those in. They're really good about that, about baking them in, but sometimes a little bit, not quite Betty Crocker wise, but they sometimes overdo it, don't they?
Well, they do. That is a term that's used in the financial markets about considering sort of seasonal changes or unusual changes due to something like a weather related event that has a temporary shock on the numbers. And so I think on the labor market side, you're right. If we see some increase in initial jobless claims, which we probably will, you got to take into account when those are occurring as it relates to other events going on overall, like a weather-related event like a couple of major hurricanes. The baking in term is interesting because as I was trying to urge people early September, late August, early September, approaching the Fed meeting, I kept saying it. All the people I'm interacting with, prospective borrowers, home buyers, homeowners looking to refi, is, hey, look, the improvement that we're expecting on September 17th or 18th is already baked in. Take advantage of it now. If it turns out we're wrong and things improve after that, you've already locked your rate, and then we can do a renegotiation of your rate, but at least you protect the upside. Unfortunately, I had a few folks who just, nodded their head, duly noted, and decided, no, I think the Fed is who I want to wait for because I think that's going to help. Well, of course, we now know it didn't, and we now know the reason why is because the Fed doesn't directly control your mortgage rate. It's going to be the labor market. It's going to be the inflation numbers. So I think this has been a kind of a painful but learning lesson for prospective borrowers, both on the purchase side and the refinance side, that you've got to look at other factors. And if you do that, I think you're going to be better equipped to deal with this and not put yourself, frankly, in an emotional roller coaster that can occur when you are in a transaction, for example, and you decide to float because you're waiting for the Fed, and then things go exactly the opposite of what you expected, that can be very, very stressful. And that's another reason why locking in a rate sooner than later, I think, is always, always, always the best recommendation.